The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Hi there, welcome to our live webinar with us from Phillip Nova. And who do we have in the studio? We have Tan Teck Ling, who's a senior fund manager, and he's going to be telling us the strategies of how you can combat the rising inflation. As you know, in Singapore, core inflation rose to 3.3% in April with a 0.4% increase for the 2.9% which was recorded in March. This is the highest since March 2012, and it could rise even further as commodity prices increase due to the geopolitical tensions. The Monetary Authority of Singapore took the step of tightening monetary policy by strengthening the Singapore dollar to combat inflation. Inflation has hit multi-year highs for countries like the USA, UK, and Japan, while a stronger Sing dollar will help to soften the blow of inflation as Singapore imports almost everything. This is also one of the main causes of rising prices in Singapore. Teck Ling will be walking us through two different products, the Phillip MSCI Singapore Daily leverage product, two times leverage product rather, and the Phillip MSCI Singapore Daily minus one times inverse product. These are exchange traded products that are traded through the exchange, and he will be walking us through how you can use these products to combat the rising inflation in Singapore. In the studio with us, we have Teck Ling. As I mentioned, he's a senior fund manager and a key member of the investment team covering global equity markets, including both active funds and ETFs. He oversees the managed account portfolios and the management of the equity and balanced funds portfolios. Prior to joining the group in 2008, he worked in the aerospace and defense fields with a Singapore-based engineering conglomerate and had project management experience in a regional construction and infrastructure engineering consultancy firm. And I assure you, you're in very good and stable hands. Teck Ling, before I hand the reins over to you, members of the audience, can you please head down to the question box and let us know if you can hear us loud and clear. Just type yes into the question box, which is located somewhere at the bottom of your control panel. This will be the same box which you'll be using to ask questions later. So just type yes in the box if you can hear us clearly. All right, thank you so much. Teck Ling, if you're all set to go, I can hand the reins over to you.
Hello, yes. I assume you can hear me loud and clear. Thank you very much.
Yep. We can hear
Thank you very much for the invitation. Thanks. Yep.
No problem.
Yes, hi.
If you're good to go, you can have your webcam on as well.
Yes, okay. Hello all. Yes, hello, I'm Teck Ling, and I run funds over at Phillip Capital Management. Phillip, of course, there are many arms, and we are the fund management arm of Phillip Capital. And our sister companies, you would be familiar with Phillip Securities, Phillip Futures, and so on, right? So essentially, what we do is we manage unit trusts as well as manage accounts, and we have under our management also passive products. So we came out with ETFs since 2016. And since then, we have quite a suite of products. And today, I'm going to be talking about two of those passive products. Passive products meaning that basically they are run according to a transparent set of rules. So you know exactly what is the benchmark that is follows, and you know exactly if the benchmark moves, by how much that product actually moves by. It will typically track that benchmark basically. So today I'm going to be talking about these two products as has been mentioned. And let me switch over to the slide mode. Right. So as you can see, these are the two products that I'm going to be talking about. The Singapore 2x leveraged, and then the second one is the Singapore -1x inverse product, both traded on the SGX. Now, when you talk about well, I mean inflation, basically when you have inflation, or now it's actually the narrative changes quite a fair bit, because previously people were talking about lower for longer interest rates, and then after COVID, suddenly the narrative switches over to inflation for longer, right? Rising inflation, rising interest rates that are going up very fast. And recently, if you follow the news, in fact, people now talk about recession, right? Because when you have interest rates moving too fast, then it sort of has a dampening effect on demand. And now people are talking about recession because the rates are rising so fast. Because that rising interest rates has an effect on consumption, on the cost of debt, of course. So that definitely has an impact on economic growth. So when I'm talking about these strategies, today I'm more like offering you trading tools to combat all of this volatility, right? Because what you really see today is a rapidly changing narrative, and therefore accompanied by it is high volatility in the markets. Is moving very fast, whether in the US or in Hong Kong or in Singapore, it's the same thing, because changing narratives leads to changing markets, and therefore the markets will respond accordingly in a quite rapid fashion. And how do you take advantage of that? That's the key thing. And that's why today I'm talking about trading tools. One is a bullish trading tool. That's why you see the bull next to the Phillip long Simsky 2x, which is the leverage product. Then you see the bearish trading tool, which is the Phillip short Simsky -1x, which is the inverse product. Okay. Now I will go on and we'll have a look at what we are going to be covering today. This is essentially the agenda for my presentation today. So I will talk about what are L&I products. L&I stands for leverage and inverse. Okay, so that you get an idea of how common they are, and you know who else has it. How big is this market globally? Who are they suitable for? Then third one, I'll talk about key features of such leverage and inverse products. What is their typical portfolio? How are they typically managed? And how do they perform typically? How would you expect them to perform typically? Then I'll give you an introduction to our two products that we launched in December 2021, just about 6 months back. We launched these two products together. So the first one is the MSCI Singapore 2x leverage product, which is the bullish one that I mentioned. Then we also at the same time launched the MSCI Singapore -1x inverse product. That's the bearish one. Okay. So basically it offers you a toolkit to amplify your views if you are bullish, or to hedge your long exposure if you are bearish. So I will talk about using some examples. I'll talk about how leverage and inverse products can be used, and lastly a short summary of why trade leverage and inverse products. And I think I will reserve something like 10 to 15 minutes for question and answers. And that would probably conclude at 8 o'clock. Okay, so what are leverage and inverse products? So essentially, these are basically passive products. So you might in the US, I think some of you, if you are active traders in the US, you might, or even in Hong Kong, you might be familiar. They already have that, like ProShares, 2 times or even 3 times S&P 500, or ProShares ultra short 1 times, or even minus 1 times, minus 2 times S&P, right? So basically, what they seek, leverage products, they seek to deliver multiples of the performance of the index or the benchmark they track, right? So it's a passive product because you know exactly how it's performed. There is a benchmark, and basically they are supposed to deliver multiples of the performance of the benchmark, right? So if the benchmark is S&P 500, then and the product says it's 2 times leverage, then it's supposed to, for every 1% rise in the S&P 500, this product would deliver 2 times of that 1%. Okay, so essentially it's a bullish trading product. It aims to magnify returns on the investments. Okay, on the other hand, the inverse is of course the opposite. Again, there is a benchmark that they track. So if it's a minus 1 times S&P 500 inverse ETF, inverse product, so basically what it means is that the benchmark is the S&P 500. For every 1% rise in S&P 500, the inverse product actually delivers the opposite. That means it will drop 1% in the return for every 1% that S&P 500 rises. And of course, the opposite. If the S&P 500 drops 1%, the inverse product, the minus 1 times inverse product, would gain 1%. So essentially, it's a bearish product, as you can see. It aims to deliver returns when the market is falling. Last thing is that typically this, whether it's L or it's I product, they would typically adopt a trust structure. Trust structure meaning that you have a fund, it is a managed product, so you have a fund manager. Then there is a third, there's an independent fund administrator that values the product on a daily basis, right? Then it is and therefore basically and usually trust products, they are also well regulated by the regulators. So so for example, in the US it's the SEC, in Singapore of course it's MAS, right? So these are actually so for example, it's no different for our products. It's regulated by the Code of the Collective Investment Schemes, which is administered by the MAS, and this same regulatory code also governs unit trust. It also governs normal ETFs. So basically, this is how L&I products structure is like. And lastly, they are traded on exchanges. So as you know, you might see that like ETFs are traded on exchanges, right? So are the leveraged products and the inverse products already traded on the SGX. So just to give a idea of the broad landscape of the leveraged and inverse ETFs available globally. So in the US has typically been the pioneer in such leveraged and inverse ETFs. So actually the first ETF leveraged and inverse ETFs in the US started in 2006, right? First listing. And now you can see that there are 132 positive leveraged ETFs in the US and 104 inverse ETFs over in the US. Now, for the Asia Pacific, they came later, but also as you can see, they have also become very popular. So in countries such as South Korea, Japan, actually in much of North Asia, the trading value of the trading volume, the trading value of leveraged ETFs and inverse ETFs actually accounts for a large part of the total market trading volume. And South Korea started in 2009, the first L&I ETFs, and then now they have 87 and 104, as you can see, right? Japan, Taiwan, or Hong Kong, right? So basically, we were the first. Phillip Capital Management were the first to come up with such products, and we started it last year. So now Singapore has one positive leverage exchange traded product and then one inverse exchange traded product, right? Lagging a bit behind, but better late than never. Target user group. Essentially, it's meant for those more experienced traders, right? So traders who may include trading representatives. That means remisiers, professional traders. They may use this to add value to their portfolio, right? But also general investors like you, if you are looking for tactical trading tools because you don't want to just let your portfolio run on autopilot, you want to try to add value through the daily volatility, right? Especially now that the market is going up, going down, going up, going down, ending going nowhere, right? And one thing to note is that you must be qualified to buy SIP products, so that's specified investment products. So your remisier will be best able to advise whether you are qualified to buy if you are not sure whether you're able to. But usually if you are able to put an order through for the SIP product, such as the leverage or inverse, then that means that I think they would have qualified you through the platform. If you're not sure, you can check with your trading representative. And I think what you need to understand is, firstly, that leverage and inverse products are basically tactical trading tools. Tactical trading tools, which means that you are using them more to for short or medium term exposures to the market in order to capture the volatility and add value. It's not really so much buy and hold, right? You don't buy and hold them, like they are not really although their benchmarks are actually an index of blue chips right? Usually it's like that. For MSCI Singapore, for example, it's basically an index of blue chips, but you're not really meant to hold these instruments over like 1 year or 5 years and sit on them. It's more like tactical trading tools. That means an overlay on top of your buy and hold portfolio, right? So that's one thing to understand. Risk is associated with use of leverage and inverse. I think that's self-explanatory, right? Because if you use leverage can cut both ways. You can either magnify your return or you can magnify losses, right? And inverse exposure, the risk, of course, is that if the market gains and it keeps going up, your inverse exposure is going to lose money pretty rapidly. Consequences of seeking daily rebalance. Now, one thing to note, and you can read up more because I won't cover the quantitative part of it. Basically, the leverage product or the inverse product, the 2 times leverage and the 1 times inverse, that is exact on a daily basis. That means for that day one, if the benchmark index goes up 1%, you would expect that the 2 times leverage product would go up exactly plus 2%, or the inverse product would go down exactly about minus 1%. But over an extended period, say like 1 month, then if the benchmark index goes up 10%, now the 2 times leverage product may not go up exactly 2 times 10%, which is 20%. It may be slightly higher, it may be slightly lower, right? And that's the daily rebalancing part of things, right? But by and large, the longer the period, the possibility that the divergence from the expected return would maybe be greater, right? Typically for a trending market, that means if the benchmark index is going up day by day, then actually you would expect that the return would actually, from your leverage product, for example, would actually do better than what you would expect from a 2 times of that benchmark index over a long period. On the other hand, if the benchmark index is up down over a daily basis and going nowhere, then you may expect that actually the 2 times leverage product, for example, it may underperform what you would expect. That means if the index goes up like 5% over 1 month, and the index has been going sideways, up and down, right? basically very volatile, then you may expect that your 2 times leverage product may actually not go up 2 times 5%. It may be slightly below that. That means it may be slightly below 10% return, right? So that's the consequences of daily rebalancing, right? That's a feature not just of our L&I product. It's a feature that is standard across the L&I products in general, whether in the West or in Asia. So that's something to note. And then lastly, that they should actively monitor and manage trades daily, and that of course is self-explanatory as again, right? Because it's tactical trading, and you expect to be monitoring it. Features of L&I products, right? So they are designed to provide multiples or inverse multiples. So I've explained that already. So actually, the name of that leverage product or the inverse product actually gives all the information that you would want to know about that product already, actually, because usually for the product, it would say what is the benchmark index inside the name itself. It will also tell you what is the leverage ratio, whether it's and also whether it's an inverse product or a leverage product, right? So and then another point is that how do they actually provide 2 times leverage return, or how do they actually provide minus 1 times inverse return, right? If you think about it, is the most cost-effective way and the typical way that leverage and inverse products usually replicate this return is to use derivatives within the portfolio, right? Which enables them to gear up very easily and cheaply to give the 2 times return or to deliver minus 1 times inverse return, right? So usually the derivatives that they use, if you look at Asian L&I ETFs in general, usually they would use exchange traded futures that track the benchmark. So that's the most liquid and the most investable in derivative, right? And it's also the same for our products as well. Okay, so I hope that I have given a good landscape description of the whole L&I and also their typical features. So at least you have a better idea. And now I will go on to the 2 products, right, that we have. The first one is the MSCI Singapore leveraged 2 times leverage product, and then the second one is the minus 1 times inverse product. Now, before I start talking about these products, firstly, what is the MSCI Singapore Index? I think that is important to give you a flavor of what it comprises. No, I think for me, most of you will be familiar with the STI, right? The STI index. So it's the one that is always reported in the newspapers, and I guess associated reason is because it's been in use for the longest time. But also MSCI Singapore Index is something that is an index that is actually one of the most followed indexes that track Singapore by investors outside of Singapore, right? Actually, international investors probably know the MSCI Singapore Index. When you talk about Singapore equities, they probably know it more than the STI index. And also, if you look at the Singapore futures market, the futures contract that actually trades Singapore is actually the MSCI Singapore futures, right? So MSCI Singapore, the SIMSCI futures, basically what they known as SIMSCI SIMSCI futures, is actually using MSCI Singapore Index as the underlying. So and of course this index is also used by our 2 L&I products as the benchmark. So if you look at, to give you a flavor, basically you can see that it's an index of blue chips. Is something that is actually quite close to the STI Singapore. So for example, you can see that the 3 banks, DBS, OCBC, and UOB together, for the MSCI Singapore, they comprise more than 40% of the index. And that is also something similar to about the STI as well. STI also is also about that proportion for financials as a part of the total. So you can see many familiar names. So together, the top 10 names inside this index, there are 20 names basically inside this MSCI Singapore, 20 constituents. And the top 10 names, you'll be very familiar with them. Singtel, the three banks, CapitaLand, Integrated Commercial Trust, CapitaLand Investment, Capital Corp. You may not be that familiar with C, which is actually listed in the US, but is nonetheless considered a Singapore stock. That's why it's in the MSCI Singapore Index. Well, the top 10 constituents actually comprise more than 80% of the index. So you can take it as a way to trade the Singapore blue chip market, in other words, right? If you are positive on the Singapore blue chip market generally, or positive on Singapore generally, this is a good proxy essentially, right? Then I go on to the first product that I'll talk about today, which is the MSCI Singapore Daily 2 times leverage product. So like I mentioned, the name itself, this is the full name for this product. The name itself basically gives you the whole investment objective at a glance already. The benchmark is MSCI Singapore and it's 2 times leveraged, right? So for every 1% rise in the MSCI Singapore for the day, then this product will deliver 2% gain, right? For efficient Singapore market exposure. And this is therefore a good way to capture the bullish return, right, on the Singapore market in a very quick way. Some particulars. So investment objective: to provide investment results that closely correspond to 2 times the daily performance of the MSCI Singapore, right? Benchmark index, MSCI Singapore. So listed on the SGX, right? And actually now you can actually buy the product at one unit already. So it used to be 100, but the SGX has actually made it even more convenient. So you can actually buy them 1 unit at a time already. So for ETFs, it's actually very well fractionalized. So the product was launched at $2. Because of the market, actually now the price is trading at $1.30, $1.40 already, because the market has been on the downtrend, right? So we launched at $2, and it's actually available to trade on the SGX in both Sing dollar counter or a US dollar counter. But I guess most traders, most investors or traders would be using the Sing dollar counter because your natural exposure is natural currency is Sing dollar. Okay, and it can be created, and basically it also has the features of like a unit trust for those investors who want to trade in bigger sizes. It's considered SIP, so like I mentioned, it must be traded. You must be qualified to trade SIPs. There is a dividend distribution for the leverage product, right, annually, and that comes from the stocks that it also holds in addition to the derivatives. Management fee of 0.9% per annum, right? Actually, if you compare this management fee to leveraged products that are also on the market, they are pretty competitive. So for those of you who might trade other leverage products, the management fee for this, we consider it to be quite competitive. If you want to leverage up or to trade the inverse of the MSCI Singapore, the management fee for this is quite cost competitive. It's a trust, so therefore there is a manager, Phillip Capital Management, and there's also a trustee and fund administrator, which is HSBC. Yeah, so that's the parameters of the leverage product. How it can be used, right? So I will give a quick example. But before this, basically, is some of the benefits of using these products, okay? Ability to profit in bull market quickly, right? Because it's 2 times leveraged. Leverage without the use for margin, without the need for margin, right? So in the past, if you wanted to gear up your exposure, you probably would have to open a margin account, and then you buy the, you borrow money from the margin account, you take up margin debts in order to buy more stocks in excess of 100% exposure, right? So by buying a leverage product, actually we are able to achieve this for you, leverage without opening a margin account. And it's an alternative to using derivatives of futures, right? As I mentioned, the L and I products themselves are basically using derivatives to leverage up the exposure. So when you trade the leverage product, basically is an indirect exposure to using the futures, in other words. But some people don't like to use futures directly because they are not so familiar. They might be scared of margin calls. They don't want to monitor their margin positions. And on top of that, you may know that futures actually it can be a month. For example, the Simsky futures contract is a monthly contract, and therefore you got to keep rolling them over at the end of every month. So that's very inconvenient, and that is why some people like to use L&I products, L&I ETFs, because the fund manager, the manager actually takes care of all this for you, right? So you don't have to worry about all this contract rollover or margin maintenance or so on. Now, what can the leverage product can be used for? Market exposure in a quick, capital efficient manner with limited liability. Limited liability meaning that you put up $1,000 to buy $1,000 worth of leverage product. $1,000 is the maximum that you will lose. That's all. Even if the benchmark index goes to a very low value, $1,000 will be the most that you will lose and not more, right? So you don't have to worry about no margin top-ups. Of course, for example, if you trade futures, you have heard horror stories, right? Like the index goes up, there is a market plunge overnight, right? Then suddenly there is negative equity, you got to top up, yeah, or you might be even in the red and be in debt, right? So there is no such issue for leveraged and inverse products, limited liability. That's what it means. And opportunistic trading and trading volatility and momentum. This is basically what the leverage product can be used for. As an example, opportunistic trading. You can position the portfolio ahead of earnings announcements, especially by the blue chips that are constituents of the benchmark index in MSCI Singapore, or when the US, or when you expect the US Federal Reserve is going to be announcing something bad, announcing something unexpectedly good for the week, you may want to position your portfolio in a bullish manner by buying the leverage product in advance, so that so you can achieve maximum return when that bullish pronouncement by the Federal Reserve, for example, comes about. Calendar effects, right? You might have heard of the Capricorn effect, Santa Claus effect, end of the year, start of the year. The market tends to be stronger. Maybe you want to position for that opportunistically to magnify your return. You may want to use the leverage product, or basically other perceived market turning points. Right? For example, a very good example recently, of course, is the COVID induced plunge in the March 2020, right? The STI basically dropped something like over 20% within the month of March. So if you had been able to position bullishly at the bottom of the market and you used a leverage product to capture maximum return, that would have been one way to trade the market in a capital efficient manner, right? A quantitative example would be here. Supposing that you start with a long stock portfolio of $100,000 on the left, and that is your neutral portfolio setting. You are short-term bullish. Therefore, on top of your $100,000, you buy another $50,000 worth of leverage product. $50,000 gives you $100,000 long exposure, because as you remember, the leverage product gives you 2 times exposure, right? So the power of the $50,000 exposure is amplified by 2 times to $100,000 long exposure. So effectively, you have $100,000 plus 50 times 2, another $100,000 long on the market by buying the leverage product. And then, that's how you can do opportunistic trading using this product. And then you take profit once that short-term bullish environment, bullish catalyst does materialize and push up the market, right? So you can take profit and then you can go back to your long only stocks. So so one thing to note, so therefore it's basically like a portfolio overlay. And the second thing is basically it tends to be used more for a short or medium term to amplify your return. MSCI Singapore inverse product. So you gain from market weakness. So it's basically a bearish market instrument. So some people are looking for that because I guess there are not many. You know, you look at the SGX, basically everything is, most of the things are stocks. So stocks are intrinsically bullish instruments, right? But how do you protect your portfolio? So this is where this comes in. Is to the investment objective for this inverse product to provide investment results that that closely correspond to the inverse return of the MSCI Singapore Index, right? The other parameters are more or less the same. So the inverse product launched at $2 Singapore dollars in December last year. So today, because of the down market, is now trading at $2.30, $2.40, right? So that's to give a flavor of you know, how it has performed over this half year. And that's to be expected because the market has been more bearish over this period. It's a SIP as well. Management fee 0.9%. We think is pretty competitive with other comparable products. And trust structure. So that the main players are also the same. Ourselves as fund managers and HSBC as the custodian, fund administrator, so on. How it can be used. So basically ability to profit in bear markets. You can short without the need for shares borrowing. So same thing, you don't actually have to open a shares borrowing account in order to short the market, right? Similar to the leverage one, you don't have to open margin accounts. So same thing here, you don't have to open additional short shares borrowing facility. It's an alternative to using derivatives of futures, again, same thing. Now, so inverse product, as I mentioned, it can be used for hedging or even naked shorts, trading opportunistically. An example is here. So say, for example, you are short-term bearish on your on the environment going forward. So you happen to have a $100,000 core portfolio in Singapore stocks and you want to protect that. So that's when you can buy the inverse product. So if you hold $100,000 worth of the inverse product, that gives you $100,000 short exposure on the broad market index MSCI Singapore. So assuming that short-term bearish environment transpires, then you would have a profit on your inverse product. And that's when you can take profit. And then that profit would be expected to offset the loss on your core long-only portfolio. So basically offsets your losses through your gains on the inverse product. So you can take the gains on the inverse product and then you can go back to your neutral portfolio setting. So that's one way that you can use this to hedge your portfolio, right? This is just to give an example in more detail of the MSCI Singapore Index. If you had been holding just a long-only portfolio that is modeled on the MSCI Singapore in over 10 years from May 2010 to May 2020, excluding dividends, okay? If you include the dividends, of course, it will be higher. But if you just look at just price return, basically excluding dividends, the MSCI Singapore actually would have delivered negative minus 9.5% in price return over these 10 years. So basically, you would have helped to the portfolio for nothing except the dividends over these 10 years because the capital gains are negative. Suppose you had actually hedged 3 short periods over these 10 years, you would have ended up with 70% positive return over these 10 years. So that's a big difference, minus 9.5 versus positive 70. Which are these 3 short periods? From August to September 2011, when global markets, including Singapore, collapsed because of the fiscal crisis in Europe. If you remember the PIIGS, Portugal, I think Ireland, Italy, Greece, Spain, the Europe peaks fiscal crisis. You had bought, if you had hedged it, say for example, if our inverse product had been around and you had bought such a product to protect your portfolio, 100% of your portfolio. Second episode, the China renminbi devaluation and also the associated emerging markets crisis in 2015 to 2016. So it's a slightly longer period over August 2015 to January 2016. But as you can see, also there was a big drop in the Singapore index. Again, if you had protected your portfolio with a hedge over these few periods, and then thirdly, this one is a very short one. The recent COVID crisis from start of March to end of March 2020, just within 1 month, right? If you had hedged your exposure over this 1 month period, 100% hedge lah. So these 3 short periods, if you had used an inverse product to hedge, for example, to protect a portfolio, then you would have ended up with much better results, right? So that's the power of using trading tools, right? Of course, this is a very wishful scenario that you have been perfectly positioned in this way. But generally, I think you can see that the power of using hedging in an effective manner. Essentially, why trade L&I products? So efficient market exposure. So leverage exposure, so therefore less capital to put up. You can buy it on the SGX very simply, right? And you can monitor it with the rest of your stocks, right? Because it's L&I products. Our 2 L&I products are also listed on the SGX, and they trade just like normal ETFs, just like normal stocks. And basically, they also are, you can see it on your stock screen at the end of the day, right? So very convenient, rather than you have one screen on stocks, one screen on futures, for example, one screen on other things, right? Very difficult to monitor. No need to open margin accounts. No need to maintain margin accounts. No need to roll over monthly futures contracts. So that's the advantage of L&I products as compared to futures if you trade futures directly, right? So that basically is a solution product. Good for trading. Good for trading because we actually work with the market makers. There are committed market makers actually for all ETFs and ETPs. Actually, the SGX requires committed market makers known as DMM, designated market makers, to provide both bid and ask prices and also bid and ask volume. So always there will be a committed market maker to provide buy and then also commit to provide the sell bids and volumes. So you don't need to worry that you buy already, then you find it very difficult to sell, or you worry that it becomes very difficult to sell at very difficult price. The price becomes very prohibitive, too far apart from the theoretical pricing. No, it will not happen because you have DMMs, committed market makers, to do this. Low transaction costs. And what this means is implicit cost means that the difference between the bid and the ask is the difference of the bid price and the ask price from the theoretical median price. The spread is very thin, right? And therefore that cost to you is that is an implicit cost, because when you want to exit, you don't want to be selling at too far away from the theoretical price, so-called elephant spreads. You don't want to do that because there's an implicit cost to doing that. I think if you exchange your money when you go overseas at money changes, right? You would know what I mean by implicit cost lah. If the bid and the ask is too far wide, that is actually implicit cost to you. That means the transaction cost actually becomes very high. So we ensure that this is not the case for L&I products by working with market makers. Thirdly, transparency. The benchmark MSCI Singapore is widely followed and therefore is quite efficient. The main replication instruments, that means we use MSCI Singapore futures, commonly known as SIMSCI futures, because these are very well traded on the Singapore Futures Exchange. Therefore, by using them, our L&I products also ensure that they are efficiently priced, right? And thirdly, we actually have intraday theoretical NAV pricing as a reference. What this means is that you can reference that whenever you want to buy the leverage product or inverse product. You can reference that on our Phillip Capital website to see whether it's what is quoted by the market makers, is it reasonable as compared to the theoretical live NAV pricing. I will show you in next, but first I will show you the actual quotes. So you can see, for example, the LSS, which is the long MSCI Singapore 2 times the leverage product. You can see that there is bid volume 5,000, there is ask volume 5,000, and then the bid price and the ask price, you can see that they are very close, 1.950, 1.953, just difference of three ticks to the third decimal place. Same thing for the SSS, or the inverse -1 times inverse product, 2.002, 2.003, and then the bid volume is 5,000, ask volume is 5,000. So again, there is committed market makers providing that kind of liquidity. Okay, so that's what I mean by a low transaction cost and committed market makers providing liquidity. Now, transparency, what do I mean? So if you go to our Phillip Funds website, so this is what I highlight here in red, phillipfunds.com, right? And then you go to our products, you can see our MSCI Singapore 2 times on our website. You can see the MSCI Singapore 1 times inverse on our website as well. Then you click straight into the product itself. For the inverse, for the leverage product, you can see the theoretical valuation as shown in the yellow box for both the US dollar counter for this product. Remember, there are two counters. One is the US dollar counter, one is the Sing dollar counter. So you can see the Sing dollar counter, for example, if you're trading that at that point during the trading day is trading at the theoretical pricing is 1.953, right? So if the market maker is, so you can check this theoretical valuation versus what is being quoted on the SGX for this product to make sure that it's not too far off. Okay. Same thing for the inverse. The one highlighted in yellow is basically the theoretical live pricing at that point in the trading day. So it's trading at so its theoretical pricing is 2.001. So let's say the market maker is quoting something close to this, right? Then you will be assured that when you buy, whether you buy or you sell this product on the SGX, you are trading at a relatively fair pricing, right, compared to the theoretical pricing 2.001. Okay, so that's one way to ensure transparency, and that's how we do it. Okay, so I will leave some time, as I mentioned, to for questions, and basically I leave you with this a short summary of these two products. If you have problems finding these, you can go to the SGX and just type LSS for the leverage product, or SSS, which is for the inverse product. Very easy to remember because the ticker on SGX, LSS for the leverage product, long Singapore stocks, right? So you can remember this easily, right? LSS. For the inverse product is SSS, the ticker on the SGX. So you go to the SGX website, you type SSS and search for these short Singapore stocks, right? So that's what it means. Very easy to remember, I hope. And lastly, I will leave you with our contact details and also the website that I mentioned where you can check some of these intraday theoretical NAV, theoretical price, right? That's on our Phillip Funds website, right? If you have any questions, you could drop us a line, or you can check with your Remisier. Okay. Okay, so I think thank you very much. That's all for the moment. I'm happy to take any questions. I think there would be about 10 minutes.
Hey, Ting Leng, we're not going to let you go so soon. We have a couple of questions in the question box, members of the audience. If you have more questions, please send them via the question box on your control panel. Head down to the question box and type your questions in there, and we'll pick them up and have Ting Leng address them. The first one is something that I was thinking about as well. Why is this the products that you shared? Why are they called a product as opposed to an ETF? Would you be able to share more?
The reason is because the authorities, basically SGX, MAS, they want to make this distinct from what people associate with ETFs generally. So the ETF term is reserved for vanilla ETFs that are tracking index that are not leveraged or inverse, right? So this is a deliberate intention of the regulators to make sure that this is, is not to be confused with the traditional buy and hold type of ETFs, right? So in other domiciles, I guess, such as the US, they don't really make such a distinction. So some of you might know, like the Direction L leveraged ETF or ProShares leveraged ETF, right? But in Singapore, I think this is what they intend to do, to make a distinction between leveraged ETP, they call it ETP, exchange traded product, versus normal vanilla ETFs, right? But I think I do emphasize that actually in terms of structure, the leveraged and inverse products are actually similar to normal ETFs. Structure meaning they are also trust structure. You have fund managers, and then you have third party fund administrator that check the values on check the valuation on the daily basis. So there's segregation of duties, and lastly that they are also administered and regulated according to the same code as normal ETFs and unit trust, which is the code of CIS, the code of collective investment schemes, right? So that is the main thing. Thanks for asking that. Yep.
So basically, it sounds like in Singapore, just to ensure that the investing crowd or trading crowd are aware that it's a tactical product, it's called an exchange traded product. Is that correct?
That is correct. Yep.
All right. While we wait for the next question, I have a question for you, Ting Ling. My question is, based on what you have shared today, what would be the key takeaways that you want the audience to have?
The key takeaway is if you are looking to have a overlay on your portfolio, if you are not content with just letting your portfolio settle along with the general market and hopefully to have a positive return by just doing a buy and hold approach. If you are not satisfied with that, then or you are concerned about market volatility and you are wondering what is the best way to get additional return rather than just having a buy and hold approach on your core portfolio, then definitely this is the way to go. Second takeaway is specifically for the Singapore market, I guess. I think some people think that the Singapore market is actually not is quite a boring market. But that's the reason. The reason why is because they look at the index and it does nothing over 10 years, right? So, but I've just shown you that actually you would have been able to juice your returns quite significantly. And there is volatility in the Singapore market because, after all, Singapore is it is basically a sampan on international waters, I think, has been described by our leaders, and it really floats, and it really floats and in unison with the international external economy. So that's the reason why you can see that it goes up so much and actually goes down so much over the years. I think what people miss is that you know, rather than looking at the endpoints, and you conclude that the Singapore market is going nowhere and therefore a boring market to trade, look at the intra periods over these 10 years, and the opportunities of trading these are enormous.
All right, thank you, Teck Leng. Maybe one last question. Based on what's happening right now in the market, we are seeing signs of increasing inflation, and if you're a trader in Singapore, you've been regularly trading stocks. Based on how the scenario is panning out right now, what would be a possible strategy for a trader to utilize this contract? Maybe we can cover that to let us know.
Sure. For inflation, the obvious opportunistic trade would be to position your portfolio in anticipation of the pronouncements from the Federal Reserve. The Federal Reserve, as you may know, the US Federal Reserve, they decide the interest rate moves every month, basically every month, right? So and that is definitely market moving. We typically the 1 week before the FOMC meeting and decision, the market would be basically speculating on some of these moves by the Federal Reserve. So one way is to watch for is to just understand what is the expected move by the US Federal Reserve, and then if you don't agree with that for some reason, then that is one way to make a trade, because say for example, coming up the next FOMC meeting, there is a expectation that the US Federal Reserve is going to be making a 75 basis rate hike in the next move. And actually the market is pricing that in. But what if that actually doesn't transpire? Because before that, people have been expecting 50 basis points, but because of a very high inflation print recently, therefore now the market is pricing in 75 basis point hike. If they do not do that, what are the implications of that? That would possibly be short-term bullish for the market, I guess. So if you happen to believe that they may not hike rates to that extent, then I guess one way is you could be taking a bullish position through the leverage product, and then it is really a 1 week kind of holding period in that sense, right? So that's one way to look at it. It also revolves around your views on the inflation versus recession, and what the regulators would be what kind of move would they be taking. Yeah, essentially for short-term trading, you may be looking at that from this perspective. And going forward, I guess some people also look forward to the US midterm elections, right? That's widely expected to be a factor in how the US governments will be leaning upon the Federal Reserve going forward, because obviously if the Federal Reserve tightens rates too aggressively and causes a recession, that would of course wouldn't be it wouldn't be favorable for the sitting governments, the Democrats, right? So that is also something to understand, right? So yeah, so essentially, I think that is some of the narratives to understand for the short to medium term, and how this inflation narrative, how this recent recession narrative figure into the whole picture, right? it is, yeah, and depending on your reading, how that would really figure into how you want to position your portfolio to take advantage of unexpected surprises, whether on the upside or on the downside. So of course, if you expect a surprise on upside, you would be using a leverage product. If you expected a surprise on the downside, the Fed tightens, for example, more than expected, then of course you'll be using the inverse product to hedge your portfolio, right? So by and large, that is how you would see it.
That's all the time that we have for tonight. If you have more questions, you can send them via the survey form at the end of the webinar, and we will have Teck Ling look at them and provide his replies. All right, do look out for our follow-up email tomorrow. We'll share a link to the webinar recording so you can catch up on the insights that we'll share. And if you have questions, do type them down into the question box at the end of the webinar. Thank you for joining us to our next webinar. We'll see you then. Thank you once again, Teck Ling.
Thank you for having me. Have a good evening.
All right. Have a good evening, everyone. Stay safe.